let me introduce you to our first keynote speaker, Mike Power. Mike is a Professor of Accounting and Director of the Centre for the Analysis of Risk and Regulation at the London School of Economics. He is very, very smart and knows everything there is to know about risk management. He also advises or works where my financial advisor works, so I'm even more happy having heard that. And so what Mike is going to talk about is really the journey of business continuity into mainstream risk management. So please welcome Mike Power.
Thanks very much, Steve, and good morning, everybody. I hope you have a fantastic 2 days, and this evening sounds a lot of fun as well. So I'm an academic at the London School of Economics, spend a lot of time thinking about risk management. I'm also on the board of St James's Place, which is in and out of the FTSE 100 market, and I chair the risk committee, and I'm on the audit committee. So I'm kind of a user of business continuity management services. So I'm going to give you a kind of sort of bird's eye view of what I think are some of the sort of major pressures for change in risk management and some of their implications for BCM, acknowledging that you are the experts in BCM and I'm not. But I always think a view from an ignorant outsider can shine a light on certain areas. So what I'm going to talk about are some brief comments about the financial crisis, the challenges that posed to risk management and some of the responses that are going on at the moment, the impact of what I call regulatory culture, which I'll explain in more detail shortly, and the idea I've developed and seen in practice is that there are kind of two risk managements, the management that you have to present to outsiders and the real risk management, and they're not always connected, and I'll say a little bit about that. And then develop the presentation by drawing out some implications and challenges for BCM within risk management, and touch on the theme of risk culture and how BCM is a very important part of this new thing in financial services that everyone is interested in called risk culture. And I'd just like to apologize in advance because my perspective is going to be very much from a corporate point of view and probably from a sort of financial services point of view, but I hope some of the insights and comments will travel into your worlds if they're very different from that. So what were the challenges of the financial crisis? I think one of the major challenges for risk management is that we were engaged in illusions of control, as some commentators call it, that there was lots and lots of stuff going on in risk management, a huge industry indeed, and yet somehow it didn't seem to be effective when it was really needed. Enterprise risk management risk maps seem to mesmerize boards of directors into thinking that things were in control. Model assumptions around market risk and credit risk models were taken for granted, not challenged, and people didn't even know there were any assumptions, that they were just simply descriptors of reality. And a very important dimension of risk, at least in the financial sector, liquidity risk, was rather underplayed relative to technical definitions of solvency. And what we essentially had in the financial crisis was a kind of bank run. It wasn't a conventional bank run. It was a bank run in the wholesale markets where banks lend to each other, and a very small losses in the subprime market in the United States. Not very significant in absolute terms, but that triggered a loss of confidence in wholesale financing, and that just created a flight to quality, a bank run. Institutions found that they couldn't refinance themselves very quickly, and suddenly you're into a fire sale of assets, and the rest is kind of history. So what was the real kind of problems with risk management at that time? Well, it's been much written about, and there are lots of different views and case studies. One of the things I latch on to is the sort of information fragmentation in risk management. At some financial institutions, they didn't even have an aggregate view of their financial position in certain instruments because different bits of the organization were trading credit derivatives, for example. So just basic adding up the number of positions you had seemed to have failed. And I think that reflected sort of deeper cultural issue that control functions at this time, whether it's internal audit, risk management, proper compliance, etc., had very low status in some of these organizations and were very much playing catch up. So I think there's an important diagnosis is there was a sort of a risk culture failure. And I would imagine that business continuity management was at least in those financial institutions, a very poor relation of the front office. So it wasn't just banks themselves. Regulators had their eye off the ball. They were very micro-focused on the prudential strength of individual entities rather than the financial system as a whole and its interconnectedness. So as I've already said, small losses in the subprime triggered this bank run and revealed to the world just how interconnected major financial institutions were. And enterprise risk management at the enterprise level, we all know now, but it wasn't apparent back in 2005, where you thought as long as you get entity-based risk management correct, then the system will take care of itself. Well, we don't think that anymore. And enterprise risk management, or at least certain variants of it, are not very good on entity interconnectedness, on looking through financial counterparties and even infrastructure connectedness as well. And I think one of the advantages of the sort of BCM, for all its diversity, is that it is in principle very open to the idea of connectedness. That's a sort of a fundamental principle of looking beyond the boundaries of the enterprise and thinking about the position of the enterprise in its local environment and its infrastructure environment as well. So I think this is the sort of diagnosis and some of the challenges of the financial crisis. If we move on to the responses, then it's very clear that there have been enormous efforts by regulators, institutions, states, and a number of change programs. So at St James's Place, where I'm on the board, liquidity risk is now a big focus. And there have been a number of, I think, interesting kind of structural responses as well. I always thought risk management functions were quite centralized in organizations, but this was not so. But certainly since 2008-9, much more of a consolidation of risk capability into central functions with far more organizational authority. And some of you will have heard, no doubt, of the phrase 3 lines of defense, which came into existence around about the same time, a way of structuring risk management between the doing of risk management inside the doing of the business, separate from oversight capabilities, which would advise and provide critical oversight of the function, and a third line in terms of an assurance function. That's become something of a kind of orthodoxy now, and even a cliche, the 3 lines of defense. What I see in practice as I do research in this area is that all the real risk management action is in the fuzzy space between the second and the first line, and this distinction is not always so easy to operationalize at the organizational level, but nevertheless there is a kind of presumption that of this kind of structure is the way risk management should look. Within the regulator, there's been they've upped their game in terms of having a new and refreshed emphasis on the prudential strength of financial institutions. Those of you who work in the UK will know that we've now got two regulators instead of one. One focused on prudential matters, the other focused on financial conduct issues. And at the heart of the kind of prudential toolbox is a new priority being given to reverse stress testing, which I think is probably a kind of BCM concept in a different language, something that you'll recognize. What's involved there is requiring organizations to take seriously the circumstances under which they would fail completely. What are the scenarios under which business models would break? And these can range from, classic scenarios like a fall in the stock market by 40 or 50%, to pandemics, to other kinds of major supplier failures and things like that. And it's interesting, reverse stress testing or stress testing of a business model has many technical parameters, but what's important is that the senior management of the organization really buy into this psychologically. That is to say that they really think and take seriously the idea that the world could be very different from the one they live in. And I think that's probably something that is very close to the operational philosophy of many of you. But I've observed that actually chief executive officers and senior executives who necessarily, for good reasons, tend to have an optimism bias, find it very difficult to confront stress test scenarios. So there is a sort of some behavioral barriers around stress testing, even though, which are irrespective of their sort of technical qualities. As I've already mentioned, there's now a very strong accent on risk culture, but the notion of risk culture raises as many questions, or even more questions than its answers. I guess I kind of view risk culture as a symptom term, that it's symptomatic of the fact that our belief in a lot of the technical parameters of risk management has been shaken somewhat, and we realize that human behavior is obviously an important part of this, and the term risk culture is saying we need to spend time thinking about those things. Now, my colleagues and I at the LSE have done a little bit of research going around banks and insurers, asking them what they think risk culture is, and then sifting through the results. And it's a long and complex report, as you'd expect from a bunch of academics, but there are a few kind of key messages. And the sort of headline one is really, it's a lot of it's about the authority of the risk function, broadly conceived, not just risk management, but the authority of control functions inside financial organizations. And that's a function of leadership attitudes, etc. Equally, I think an important issue is the sort of attitude to what we might call trading limits, or sort of the boundaries of business and business decision making, where we saw in the crisis that these were often worked around or breached, or there are lots of special cases. This is called risk appetite in another language, but it's the same kind of thing. If you don't take the limits of your business practices seriously as limits, so that when they're breached in some sense, or when you get close to them, there's a kind of conversation or a process for dealing with that. If you don't take that seriously, then you don't really have risk management as such, and I think that's sort of poor risk culture. And interestingly, I've come across the phrase respect for control as being essential to risk culture. In other words, prior to the financial crisis, it was clear that control functions weren't respected. I'll just throw a question out to you. Do you feel in your organizations that BCM has the respect of senior management and frontline operational units that it should have? So very soft issues. These are not the issues we're traditionally used to dealing with, but these are cultural issues. And of course, there's been a huge amount of attention given by the regulator, the press, etc., to incentives, to levels of remuneration. And while I admit that's important, and I'm at the front line of some of that discussion myself, I don't think it's the most important thing. I think it's something that's been rather over-politicised, but that's a personal view. So on to the impact of regulatory culture. Those of you who work in regulated organisations, which is practically all of us, I mean, I'm continually amazed at how regulated universities are these days. Good, you might say, having been unregulated for a long time, but there is increasing regulation of the classroom. I now have to monitor students' whereabouts in ways that we didn't have to do 10 years ago for security reasons. So there's, in all businesses, and particularly in financial services, a whole plethora of regulations coming from lots of different sources. European Union, United States has some interesting sort of extraterritorial reach in some of its regulations on sanctions and so on. And of course the Basel Committee now revisiting its failed regulation on bank capital adequacy. And in all of this, it's clear that regulators need robust evidence of the processes going on inside organizations, whatever they are. And they, particularly in the financial sector, need evidence of risk management processes. There was a very interesting fine dished out to AXA just a few months ago by the Financial Conduct Authority. Essentially, AXA hadn't done anything wrong in a substantive sense, as far as I can see. There was no client detriment, as far as anyone could see, but they just hadn't properly addressed the evidencing of their processes. And this regulator has made it clear that it's going to act preemptively in such cases because of the risk that poor evidencing of process poses. That's a very different world from the one we used to live in 10 years ago, where you can really be taken to the cleaners for not having appropriate documentation. And in the face of this uncertainty, regulatory uncertainty, we see evidence that organizations are sort of gold plating, reacting by gold plating or amplifying the evidentiary requirements of the regulator, just to be sure. And that doesn't sound a kind of bad thing in itself, but it does tend to suck in talent, which could be better deployed elsewhere. So we note in our study a kind of increase in headcount in compliance and compliance type departments over the period. As getting the documentation right for submission to the regulator is a kind of organizational priority. And this is a strange situation where, in a sense, the regulator becomes the client of the organization. And I think I don't really know where that process is going to end, but it has. I can understand why we are where we are in those terms, but it doesn't seem to me to be a sustainable position for business. And of course, as part of this, we have more and more zero tolerance or quasi-zero tolerance areas inside businesses, where what I mean by that is it's not particularly risk-based, where failure can't be tolerated because of the concerns of the regulator. So technical areas like client money and anti-money laundering regulations, where it's actually quite difficult to get things absolutely right. This creates a lot of nervousness of organizations because there's a perception of zero tolerance. So we've also sort of lost the narrative of being risk-based in a number of areas of risk management. And being risk-based means actually you do your best, but there is a chance of failure, and things going wrong is not always a sign that you got your risk management wrong. It's just within normal expectations over a period. It seems to me that conception of being risk-based in one's approach to activities has kind of been squeezed out. So I think that's a real worry. And coupled to that is the, if you like, the bureaucratization. I touched on it before with the AXA fine. The bureaucratization of risk management in which demonstrable process, endless PowerPoint slides like this one being presented to boards of directors, goes on, and this has a what I would call a crowding effect on more thoughtful approaches to risk management. And I wanted to sort of characterize that crowding effect by talking of the sort of two risk managements, which I mentioned at the beginning of the talk. And this is all a bit of a kind of parody, if you like, but it does have some important messages. So I distinguish between what I call the formal and the clean risk management, and the informal and the messy risk management. So the clean risk management is defined by enterprise risk management templates and the giving of an appearance of control via risk maps. I, as a chair of a risk committee, I look at endless Excel spreadsheets with various colours on them. We all do that. That's become a bit of an industry. I hope, like you, I find those sometimes rather mesmerising and not very useful. They're certainly good as a kind of window into a conversation, but as an end in themselves, they're very imperfect. And as we all know, they don't show risk connectivity at all. You have to hunt for that in a spreadsheet. And maybe there's some Wizzo kind of spreadsheets out there in the hall that give you that kind of connectedness. The dominant focus of this clean risk management is controls, and again, I'm being a bit unfair here, but at the centre of it all lies the sort of internal auditor action points. If you can clear the action points, well, we're fine, aren't we? And uncleared action points, or the non-executive directors sort of say, this is terrible, you know, we should clear our action points. Really, I mean, it is a kind of discipline, but it seems to get disproportionate attention in organisations. And all of this is really designed for a nice, safe world with a few wrinkles in it. It's designed for business as usual. It's highly institutionalised. Lots of professionals work in this space. There are lots and lots of best practice standards which compete with each other. But there is a sort of underlying compliance mentality which informs them, or at least is in danger of informing them. I contrast this with the kind of informal, messy stuff, which focuses on risk interconnection, surprising causal links between different bits of businesses, what some of my academic colleagues call overflows of risk that can't easily be contained in a particular cell on a particular spreadsheet. And this requires an organisation, some of its participants, particularly the more senior executives, to be culturally able to imagine, sustain the imagination of a non-normal world, to imagine the world as being different. And this reaches back to the point I was making about stress testing, not just being a kind of technical thing you do with tweaking a few variables, but it's how you stage that stress test in the organisation, who's there, who buys into the process of thinking about a rather unpleasant future for the organisation. And it's interesting, compared to the clean risk management, is that these processes have what I consider to be very low institutionalisation. They happen in kind of very ad hoc ways, often driven by enthusiasts inside organisations. I'm sure many of you are those enthusiasts. So stress testing, not just financial stress testing, but the development of scenarios and the posing of what-if type questions are very important in this messy world. They're not easy to contain. They require people to sort of engage with that process. And again, the question I throw out to you to think about is, in your practice of BCM, where do you see yourself? You know, are you a mix of the two? How do you position BCM as a hybrid of both of these components? I would say, I mean, both are important, but we seem to have got the balance wrong in recent years. So what about yourselves in these 2 days and some of the sort of challenges for BCM, as I understand it, within risk management. And here I might be a little controversial for such an audience, but I would say that if history was somewhat different, BCM, we wouldn't be having this conversation. BCM would be the starting point for thinking about risk management, and that, in a sense, is the journey that Steve alluded to when he introduced me. As I read it, and again, mine is a bird's eye view, so I don't want to offend, but historically, I think BCM has been organisationally a poor relation, disempowered, in what I would call the non-high reliability operational context. So organisations which absolutely have some notion of reliability, high reliability at their centre, safety, etc. Airlines, for example, would definitely have a lot of attention on BCM. But in a lot of other organisations, it's sort of been marginalised from the main currents of risk management, outside of considerations of the business model, outside of debates about business strategy. And part of my talk is to say, what do you want to do about that? And what are the explanations for that? If that's correct, and just bear with me for a second, if that's correct, what's the explanations for that? Well, I think one of the possible explanations is really the sort of dominance of risk management by portfolio theory in finance. I mean, that's kind of where financial risk management started. And that has kind of sucked in a lot of intellectual capital. The London School of Economics, where I work, we teach the kids about value at risk models and portfolio analysis and all that sort of thing. So we're part of that system, reproducing that conception of risk management, not in my courses, I might add, but some of my colleagues. And operational risk, as you all know, was much slower to emerge and to consolidate itself from lots of different elements from the mid-1990s onwards. So relative to financial economics as the center of gravity for financial risk management, BCM looks a lot less glamorous, has less of a seat at the table. BCM also strikes me, notwithstanding the great work of the BCI, is to have relatively weak institutionalization relative to some of these other currents in risk management. What might be the reasons for that? Well, in a way, the territory of BCM cuts across a number of other sort of professional stakeholders, if you like. So accountants and auditors think they know about going concern, and going concern is a kind of BCM sort of issue. Strategy specialists think they know about sustainable business models. Well, the sustainability of a business model, subject to shocks, is a kind of BCM issue. And stress testing, as I've already mentioned, at the heart of capital management and insurance, have their own sort of pockets of expertise, but in a way, they are business continuity management issues. So I think there is a sort of positioning of BCM in the risk management fabric, which is not static. I mean, it's changing all the time and becoming more central, particularly now, so I'll mention in a moment. That is sort of a big issue for the field. And I think one of the points I put down here is sort of a clash of entities. I think what's so interesting, to the extent I know enough about it, about BCM as a discipline compared to these other things, is that they tended to be entity-based, whereas BCM specialists have a much more porous view of the organization. They'll think automatically about supply chains. They'll think about localities and businesses in the environment, as we found out in the sort of Buncefield explosion in this country several years ago. So I think, hopefully I'm not being too romantic, BCM specialists have a broader view of the organizational space than many of these others. So that, I think, is a source of opportunity. So carrying on with that kind of analysis, I think for BCM, and I speak more now as a sort of non-executive director who's sort of interacted with sort of BCM functions, I think the organisational credibility of BCM is very varied and very dependent upon the sort of qualities of the people in that area to engage with the business. And whether and how it's perceived as business central is likely to be contingent on the specific industrial sector in which it's involved. So I've mentioned airlines before, railways and so on. They're likely to have a high degree of focus here. There are also a number of perceptions and biases which may be incredibly unfair, but they're out there, and one has to deal with that. I always remember talking to executives who keep telling you, oh, we're undervalued, the market doesn't understand us. Well, actually, maybe the market is telling you something that you have to listen to, even if you think it's unfair. So I think some of these perceptions are out there. There is, rightly or wrongly, a perceived operational and technology focus, and that perception exists in part because the makeup of most boards of most large companies, at least in the United Kingdom, perhaps not Germany, tends to be full of accounting and strategy type people. It'd be a very interesting question to know how many technology people really are on the boards of at least non-technology companies. So there is that, I would say, from my point of view, a certain kind of lack of confidence at the executive level in engaging with specialist technology functions which would have a BCM component attached to them. I think the onset of the cloud, from my point of view, has changed that, and people are realizing that now has to be a strategic discussion about technology in the business. That's happened already in many organizations, but it's a kind of journey of expertise, both for boards of directors and for technology and BCM people to find a common language. It's also, and I've heard this in my experience, been regarded as a sort of necessary evil, an expense without any immediate value, a perceived value only to those organizations that had very, very specific historical experiences. So I think, like all risk management control functions, the articulation of value is a real challenge, and I'll close with a few comments about that. And I suppose the other worry is that, again, being rather simple-minded, I think BCM is about paying lots of attention to low probability, high impact events and preparing for those. One of the struggles with low probability, high impact events is to create meaningful actions for the business out of them and getting commitment to plans and contingency plans and things like that. So I think actionability is always a challenge when there are many other more readily actionable issues for executives to deal with. So that might be terribly unfair. There are kind of a collection of perceptions from, as I say, an ignorant outsider. But I think you probably have to face that ignorance as a reality in the world. So what about the challenges for BCM within risk management? Well, on a more positive note, I think, some of these will be teaching you to suck eggs, but I think they're just worth saying anyway. And it's advice I give to internal auditors and other control specialists. So there's a need for kind of really internal charismatic leadership of the BCM function to increase its organizational footprint and to be something like they had the stature of the kind of director of safety in airlines. Now, some of you will have achieved that and you'll have great relationships with CEOs and so on, but it's very patchy. And I think you don't want to be the person that's sort of brought out from time to time when things go wrong. The good thing is, I think, and it depends where you work, I know, so there's a sort of bias towards corporates. Non-executive directors like me are incredibly interested in BCM at the moment, and we're also incredibly ignorant. So I think there's a sort of fantastic opportunity for conversations informal conversations and to make those links and develop relationships with non-executive directors for whom organizational resilience, they now realize, is part of what they have to think about. So finding ways to talk to those people, creating a sort of language which can mediate between your specialist world and their concerns, I think is a great opportunity space for BCM. And I know there are some sessions later on in the conference which deal with that. So make it your job to have some kind of indirect representation on audit committee. Go to audit committee and talk about business continuity issues. Go to risk committee. In many organizations, they'll be one and the same. The other thing is who actually in the organizations you're involved with, who owns the sort of stress testing, scenario, thinking of alternative futures process? That should be you. You should see that as your job is to present those alternative realities and action plans to management. And here's the difficult one, what I'm going to say is a sort of slightly glib. It's easy to say, harder to do. But I think organizations are constituted by stories and narrative. Yeah, there's lots of kind of technological stuff, but you know, Steve got you all to kind of talk to each other just for a minute, and I could tell even that is a sort of very energizing little thing that happens at conferences, and it's a great technique. Well, that's kind of what work needs to be like. I think BCM, risk management, internal audit need to generate stories of their value, cases, vignettes, which can travel around the organization. I noticed at EasyJet, where I was a visitor, they actually have sort of safety stories circulating around the organization, private safety stories. And this helps to inculcate a discourse where resilience is a kind of normal way of talking about the business. If you can get people talking in a certain way, then a lot of other things follow. It's what my kind of more philosophical colleagues call the performative nature of language. You know, start talking in a certain way and other things will follow. So create the discourse. Yes, be technically excellent, but create the discourse. And that will involve some kind of translation in order to talk to very ignorant directors like myself. And I guess the question I pose to you is there a kind of internal expectations gap about the BCM function in the organization that you need to address and explain? Is BCM in your organization fully risk-based itself in its approach? Or are you expected to just simply be the people who make sure everything runs on smoothly and never fails? You know, what is the attitude of the organization to system failures and recovery times and things like that? Be part of the risk appetite conversation. So, you know, I'm involved in an organization where there's a sort of 72-hour recovery period for systems loss. That's the target, so 72 hours. It seems a really long time to me, 3 days. But that's a risk appetite choice, and have the risk appetite discussion and then say, actually, can we bring that down a bit? Our appetite is for a lower threshold. And it seems to me that business continuity needs to be right in there with the kind of risk tolerance, risk appetite discussion. Some of you will do that already, but it seems to me that it's a journey. And of course, you have to win the chief risk officer. You have to be very, very close to that person, their right-hand person, and help them do their job. Just finishing off on a couple of slides. One of the things I found so interesting doing the risk culture work, there was one organization and there was one guy, he was a guy, not very senior in the risk team, but he was working his socks off to build networks around the organization, a very large organization, with different key sort of functionalities, particularly human resources. So HR and risk management not really had much to do with each other over the years, and he was kind of creating this internal college of risk management allies. And I thought that was incredibly interesting, that actually there was a sort of invisible organisation within the organisation to ensure the kind of what I call the trans-organisational representation of the risk management function. And that was what he thought doing risk culture was. And it seems to me that sort of business continuity management, you have a choice, rather like academics. You can sit in your office and do stuff, or you can build these organizational networks to be effective. And those of you who do that already, the question is, is it enough? Are you doing enough? And part of that role has to be educational within the organization. So, do you see it as your job to actually build the capability of the organization to think sensibly about resilience issues? Or is that just your job? Is resilience your job, or is it the sort of education of the rest of the business? And I think if you do kind of see it as your job to kind of disseminate, I think it's a tough one, because I think really it's in the space of slow organic change rather than any kind of short-term quick fix. But one of my favourites, and I sort of, this is a function of my own personal experience, is that it's important to ensure that drills and scenarios and emergency plans and exercises, etc., increase your credibility. They don't decrease them. Or you don't have people saying, well, what was the point of that type of thing? Why did we do that? And these are very, very kind of real challenges about getting the right kind and level of engagement between BCM and the rest of the business. So I'm just going to finish, last slide. In the risk culture work, one of the kind of interesting results we had again and again is that really the position of BCM in relation to risk management was, for us, quite a strong lead indicator of the quality of the risk culture in the organisation as a whole. That is to say, the quality of the risk culture was a function of the ability of senior people to think of alternative futures and build action plans around them. So that wasn't just a peripheral part of risk culture, it was absolutely culturally central. And we saw enormous variety in the position of BCM in that sense. And in a very specific sense, we also saw enormous variety in the organizational care and attention that was paid to BCM policies and plans. So when we asked people, how do updates and reviews of BCM plans happen in your organization? It was a mixed response from, hysterical laughing, nervous hysterical laughing to, we look at that on a monthly basis. So, that seemed to me a kind of a really strong proxy for risk culture. So I think in terms of this journey to mainstreaming, I hope I've given you a kind of few little pointers and ideas, and I apologize if some of them were unduly patronizing, but the risk management space is there to be reorganized at the moment. We've gone through a huge trauma, and it's a kind of level playing field again, and I think BCM specialists have a great opportunity. There's a new openness to sort of diverse skill sets, which are not, as a professor of accounting, which are not accounting based. It always amazes me how strong the kind of stranglehold of accounting is on a lot of, and finance, on risk management thinking. And I think there's also just don't forget, there's a very strong societal interest in this theme of resilience at the moment. The resilience of individuals and organizations, particularly with the kind of increased frequency of cybercrime, the resilience of our cities, and the resilience of the United Kingdom as such. And I think, this interest is born of a kind of wider series of social anxieties which undoubtedly exist, and which I think business continuity management, the BCI, your field, you're uniquely positioned to address that social role. So thank you very much.